Good evening, everyone. Time for another silver update. This is a daily chart of silver provided by netdania.com. It's also overlaid with the euro, US dollar, cross. So you can see that, as I pointed out in an earlier video, that the beta was very close between these two for quite some time, and still has been in the last just few weeks or months. But you can see here we're starting to see a divergence. You can see that with silver the trend line is actually rising as far as the low that came in at the end of the year. If you look at the low in the euro that came in early in January following that silver low, we've significantly surpassed that low, and we're looking at this new low here. So they are beginning to diverge, and I think when we look at the topic of the night, you'll understand why. The other chart that's really key here we've been watching is oil, and it's in a very sharp decline now. It's approaching that key support line. We'll see if it reaches it, and it's just right on the edge of it, you can see. So oil is soon going to be testing that trend line that actually goes all the way back to the beginning of the, I call it the Obama rally, because this is the reflation after the Bush collapse that occurred in 2008. So Obama's benefited from the reflation, but we seem to be collapsing or beginning a collapse at the beginning of this election cycle or season. So that's going to be interesting to see how they deal with that. The other chart I wanted to look at briefly is the price line chart, because I've been following it. If you remember, I predicted that that even more so than Apple, which has been fairly strong lately, that that price line was a tremendously overvalued stock, and that I was looking for an incredible collapse. And you can see that it was significantly above 750, about 773 here, 774. You can see we're down to 625, and the daily chart is the most ominous because you have this type of island reversal forming here. If we have a gap down, say, in the morning, and we gap down to 600 and then go down, that would be extremely bearish island reversal. But nevertheless, I fully expect that this decline will continue. Now, Apple hasn't followed. Apple looks like it's going to try to rally and do one last blow off type top. So you can see we're up to 577. The top I picked was up here around 650. I was thinking that that was going to be the ultimate top in Apple, but it may not be. We may actually rally from here, believe it or not, which is insane when you look at the fundamentals. But that's really common for a bull market. As Jesse Livermore pointed out, one of his famous quotes about the transition from the eventual transition from a bear market or a bull market to a bear market. He said that when they finally bring the paddy wagon, they take the good girls with the bad. So the point of that is that when the bear market really arrives, everything goes down. Even good stocks are going to go down in a bear market. Now, Jesse Livermore pointed out, though, that your high flyers are usually the last to crash. And when you've got this bull that's going, you start to see some of the leaders drop off and fail. If you remember, Netflix, I think, was one of the first, and that was because of a kind of stupid business decision that they made. But you can see, and it's interesting now, it looks like, I haven't followed this for a while, it looks like we're turning around and going into new lows again. So you can see Netflix topped all the way back in, well, well, not that far back in last summer, and it's just been straight down ever since. A move from above 300, and we're now to 63. So the bear market in Netflix continues, and I think we're going to see it continue in Priceline. Ultimately, that's going to take down Apple. It's going to take down the whole market. Let's look at the question of the day, and that is from Maranatha. And this is about annuities. Brother John, I'm a new listener to Silver for the People. Prayers will be ascended for your health, family, and work. Thanks for that. Heartfelt thanks for all you do here. Currently, my parents are supported by 2 annuities. Will those dissolve when things go down? The insurance guy they bought them from says they're completely safe. Yeah. He's already got his commission. This concerns me, and other than yourself, I have no idea who to trust to get a correct answer as to how safe they really are. Perhaps it depends on what type of annuities they have, but I don't know enough about them to know any difference other than they are not a tangible asset like gold and silver. Any insight you can give me would be appreciated immensely. The Lord be with you, my friend. TD. So the question is about annuities, and annuities have kind of been one of the last bastions of quote-unquote safety. Now, if you remember in the 2008 financial crisis, annuities were definitely not unscathed. The companies that wrote those had to be bailed out, specifically AIG, and there were a lot of others. I believe MetLife received a bunch of money. We never really found out who received what, so we don't really know, but there were a lot of insurance companies that did. And so let's go to an article. This is from Ben Treese, The Dangers of Fixed Annuities. I just want to read a little part of this where he's explaining it about the danger of low interest rates. He says, let's use the banking system as an analogy in this situation. Let's imagine hypothetically that I purchase a 10-year CD earning 6%. I am well aware this is above the current CD rates, but let's play pretend for a moment. Now, the bank from which I have purchased that CD decides to lend my money to their customer at 4%. How long can a business model continue in which the lending institution owes a higher rate to the creditor than their debtors are paying for the same money? Fixed annuities are facing the same conundrum. If a purchaser of a fixed annuity is guaranteed 3.5% after 10 years, but the insurance company is not able to earn more than 3.5% on that money, how long can that mode of business sustain? Readers may find it far-fetched that one could not earn 3.5% over a decade, but consider that as of November 2011, the Dow Jones Industrial Average was at the exact same level it was in January 2000. If institutions selling annuities cannot make up the amount owed to annuity purchasers, they will have to cover that deficit with cash reserves or other profits. So that's the best explanation. There's nothing magical about annuities. You give the company your money, and it's usually a life insurance company or insurance company, and then they pay you a fixed payment. Well, where do they get the money for the payment? Well, obviously, if they're not making more money on their investments than they're paying you, then they're losing money. So if that's the case, that they do that on a continual basis over time, then it's pretty much a Ponzi scheme. Are these Ponzi schemes? I think eventually, just like the pension funds, which are promising or setting expectations of 7 and 8% annual returns, well, there's just no investment out there that does that. Annuities are going to be in the same boat. So ultimately, a piece of paper that says somebody owes you a certain amount of pieces of paper is just that. Whether it's an annuity, whether it's a CD, whether it's a stock, whether it's a government bond, whether it's whatever it is, it's a promise to pay you, and promises can be broken, and especially when you have a catastrophic collapse scenario. And that brings us to the topic of the night. This is the doom and gloom. This is a real doom report from the Raoul Pal, and this is covered on Zero Hedge, the global macro investor. I just looked over this before I did the video, and I was so impressed I decided to include it. Now, as it says, Raoul has 22 experience. This is called the end game, and he's talking about, starts off with the fact that there's really no engine of growth, and that the world is about to enter a second recession in an ongoing depression. And we'll see with the charts why he says that. The first recession really never ended. If you look at some of the figures, for the first time since 1930s, we're entering a recession before industrial production, durable goods orders, employment, and private sector GDP have made back their previous highs. So that's very important. We'll see in the charts here. So here we've got our durable goods per capita. You can see we're heading down, and we nowhere approached that last peak. Percentage of population employed. This is an absolutely frightening number because it's just, it hasn't even budged. If you look here, you can see here's 08, 09, 11, and 12, and it dropped off a cliff, and it just hasn't done anything. So that's a very, very bearish chart. UK industrial production, you can see it's rolling over into, going to be into new lows. EU industrial output has already rolled over and is going into new lows. US GDP, and we know these numbers are already cooked, but you can see it's pretty much flatlined. In fact, this will be the lowest cyclical peak in GDP growth in G7 history. These are the weakest ever foundations on which to enter a recession. The problem is down to one thing: debt. 10 largest debtor nations on Earth have total debts of over 300% of world GDP. And here's the debt ratio. I don't attach too much importance to that because those are usually cooked. History tells us that when sovereign default occurs, they can come in a series of defaults. We need to understand the history in order to grasp the present. And there's default figures. Here's predictions for what is coming. He's expecting EU sovereign default, UK sovereign default, Japanese sovereign default, South Korean default, Chinese default, and the biggest banking crisis in world history. Here is a chart. This is the MSCI World Index. I think that's an amalgamation of stocks across the world. So you can see that it appears to be tracing out one of these gigantic M for murder type scenarios. He's expecting it to drop just down through the bottom. And the index, this is a European IBEX index, and you can see it's actually broken to new lows through support. The SMI, collapse of oil stocks, and we don't know exactly what is to come, but we can all join the very few dots from where we are now to the collapse of the first major bank, which may very well be JP Morgan. With very limited room for government bailouts, we can very easily join the next dots from the first bank closure to the collapse of the whole European banking system, and then to the bankruptcy of the governments themselves. There are almost no breaks in the system to stop this, and almost no one realizes the seriousness of the situation. The problem is not government debt per se. The real problem is that the $70 trillion in G10 debt is the collateral for $700 trillion in derivatives. Yes, that equates to 1,200% of global GDP, and it rests on very, very weak foundations. From an EU crisis, we only have to join one dot for a UK crisis of equal magnitude. Then he's seeing China and then Japan, then the US, and the end of the fractional reserve banking system. The big reset. He's predicting 2012 to 2013, and the defaults would bring the largest economic shocks the world has ever seen. There'd be no trade, no shopping, no finance for farmers, no leasing, no bond market, no nothing. And he's saying it's inevitable, it's going to happen. He's expecting Spain and Italy to go, and then a complete shutdown of the financial markets. He's expecting bonds to be at 1% stuck there, short selling to be banned on both stocks, bonds, futures, and options, and CDS to be completely banned, and then just be left with dollar and gold. And he's expecting the stock markets to be closed. That is not unprecedented during bad economic times, and a closure of the banking system, a bank holiday. He's saying we have about 6 months of trading in Western markets to get ready for this, and of course that would be, in my opinion, stacking silver. So a very gloomy forecast there. Of course, a lot of people have been forecasting that. Now, just as in the case of annuities, or you can see Netflix stock, or the euro, or any of these pieces of paper, they all are just someone's promise to pay. Of course, silver and gold are not. They are reacting with this bearish, deflationary news that's coming out, especially out of Europe. But I fully expect that as this decoupling between the euro and the precious metals continues, we're going to see a rise, just as we saw a rise in gold in the 2008 crisis. I think we're going to see a rise as the default scenario becomes more and more likely. Then we will see people rushing to precious metals, recognizing that they're safe assets that do not have a default risk. And we'll talk to you next time.